Okay, if you've ever tried to, send money internationally or even just keep up with the financial headlines, well, the global payments industry is transforming at this incredible speed.
Dizzying, really.
Yeah, technology, consumer demands,
Yeah.
it all moves so fast, it feels almost impossible to keep track of everything.
It really does.
And that's exactly why we're doing this deep dive today.
Mm.
Our mission really is to give you a shortcut,
Mm.
to pull out the most important stuff from this really complex, constantly shifting world of payment regulation. We
Mhm.
want you to have those aha moments, and
Right.
leave feeling properly informed, but without getting totally bogged down in jargon.
Yeah, we spent a lot of time going through a pretty wide global analysis, lots of articles, research papers, our own notes, just trying to distill it
To
down.
get to the essentials.
Exactly. The core nuggets.
So what's the plan for this deep dive? We're going to unpack why payments are regulated in the first place.
Okay.
Look at who the key players are. And it's way more than just banks now.
Oh, yeah.
Explore how different parts of the world are handling regulation. See what the common threads are everywhere.
Few universal principles.
Right. And then look ahead a bit. New tech, what's coming down the line.
Time for the plan.
Okay, so let's kick things off. Why? Why do we even need all this regulation in payments? It seems simple, right? You tap your card, it works. But it's much more complex.
It is, and it's a great place to start because the reasons are, well, they're broader than you might think, and they're all tangled together. Number one has to be consumer protection.
Right.
And this isn't just making sure the transaction goes through, it's shielding people from, deceptive stuff, making sure terms and fees are clear.
Transparency.
Exactly. And having solid ways to resolve disputes. Like when you dispute a credit card charge. That, right, often with, say, a $50 liability limit for unauthorized use, that's regulation working for you.
And it goes beyond just the individual consumer, doesn't it? There's this huge piece about financial stability.
Absolutely fundamental. Think about it. If payment systems wobble, the whole financial system could face serious disruption.
So it's about preventing systemic risk.
Precisely. A major glitch somewhere isn't just annoying for users, it can spread like wildfire. So regulations demand really strong security, robust data protection. Because a failure can erode market integrity, shake confidence, and really threaten stability.
Makes sense.
Which is why you hear terms like integrated risk management and compliance by design. Build it in from the start.
Okay, so consumer protection, financial stability, what else? Market integrity.
Yeah, and fighting financial crime. Regulations aim to stamp out fraud, cyber threats, anti-competitive practices.
Keep things fair and transparent.
Builds trust, which directly connects to anti-money laundering, AML, and counter-terrorist financing, CTF.
Okay.
These are non-negotiables, really. Controlling dirty money, stopping terrorist funding. It's about national and global security. You've got the Financial Action Task Force, FATF, setting the global standards here.
The international rule book, essentially.
Pretty much. And one more thing, which might seem counterintuitive.
Oh, what?
Regulation also aims to promote competition and innovation.
How so? It often feels like regulation stifles things.
It can, if done badly, but good regulation tries to level the playing field. So new players, non-banks, fintechs, they have a chance to compete, but responsibly. It encourages responsible innovation.
And that's a huge shift, isn't it? Because regulation used to be almost entirely about banks.
Totally. Now the net is much wider. It includes non-bank entities. Think mobile money operators, online payment platforms.
The fintechs we hear about all the time.
Exactly. And a key term here is payment service providers, or PSPS.
Right. Define that for us quickly.
Sure. They're basically third-party companies that help businesses accept electronic payments. Credit cards, digital wallets, bank transfers, often all through one connection.
So they're intermediaries.
Yes. They handle payment gateways, processing the actual transaction authorization, clearing, settlement plus fraud detection, and importantly, compliance.
And then you have the big payment networks. Visa, MasterCard, ACH.
Yeah, they set the underlying rules, the technical standards, fees. They're like the highway operators. Their rules are a huge part of the compliance picture, too.
So the scope just keeps expanding. Singapore's Payment Services Act is a good example, right? Pulling in things like merchant acquisition, digital tokens.
Absolutely. That act from 2019 really broadened the definition of who needs to be regulated.
Which means for businesses, especially in fintech, you really need to assume you might fall under the regulatory umbrella, even if you don't look like a traditional bank.
You have to anticipate it. It's a fundamental shift in thinking.
Okay, before we jump into the global scene, let's just quickly nail down a couple of key concepts people sometimes mix up. Payment services versus payment systems. What's the core difference?
It's crucial. Think of payment services as the front-end activities, what you, the consumer, or a merchant directly interacts with.
Like making a card payment or sending money via an app.
Exactly. Credit transfers, card payments. Regulation here is really focused on consumer rights, how companies behave, data security for those interactions.
Okay, so that's the service layer. What about payment systems?
Those are the back-end infrastructures, the actual networks that move the money.
Like the ACH network here in the US or Target 2 in Europe.
Perfect examples. These are critical for financial stability. A breakdown there is catastrophic. So they tend to be overseen directly by central banks and face much stricter rules.
So it's a kind of tiered approach to regulation.
Definitely. The core systems get the highest scrutiny because they're systemically important. But, and this is key, as new services grow really big,
Like maybe some stablecoins?
potentially, yeah. If they become widely used for payments, they might cross a threshold and be designated as systemically important payment systems themselves.
So they'd move up a tier in regulatory focus.
Exactly. Regulators have to be adaptive like that. It's not static.
That tiered idea really underlines the systemic nature.
Okay, let's talk about the players in this ecosystem. It's not just one type of company.
Not at all. It's a whole network. At the base, you have the traditional financial institutions, your banks, credit unions, heavily regulated licensing, capital, cyber rules, network rules.
The bedrock.
Then you've got the payment service providers, PSPs we talked about, those crucial intermediaries.
Handling the connections.
Right. And finally, the payment networks, setting the rules of the road, the tech standards, the fees, managing clearing and settlement, fighting fraud network-wide.
So what does this interconnectedness mean for, the average person using these services?
It means compliance isn't just one company's problem, it's shared. A security slip-up at a PSP
Can ripple outwards.
absolutely. It can impact the banks they work with, the networks, and ultimately, yeah, it could affect your money or data. It's a chain, and everyone has a responsibility. All right, okay, let's go global. Because payments don't stop at borders, but the rules definitely aren't the same everywhere. How are different places handling this? Let's start with the U.S., often described as fragmented.
Fragmented yet coordinating. Maybe.
Yeah. Explain that. Who are the main players?
Well, you've got a bunch at the federal level. The Fed oversees the big payment systems, pushing things like FedNow for instant payments.
Okay.
The CFPB, the Consumer Financial Protection Bureau, focuses on, consumer protection.
Makes sense.
The OCC looks after national banks, big focus on fraud prevention. The FTC, Federal Trade Commission, deals with competition issues, consumer fraud. The DOJ, Department of Justice, handles financial crime enforcement.
Wow, okay. That's a lot already.
And then you have state financial regulators. Each state often has its own licensing and rules, especially for money transmission.
So no single boss.
Nope. Which makes that interagency collaboration absolutely vital. They have to talk to each other.
And the laws themselves are a mix too, right? Old foundational stuff plus brand new acts for new tech.
Exactly. You've got bedrock laws like the Electronic Fund Transfer Act, EFT, and its rule, Regulation E. That's your basic rights for electronic transfers, error resolution, liability limits. Still super important.
Things we take for granted sometimes.
Totally. Then there's TILA Truth and lending for credit stuff, ECOA against discrimination, even Red CC for check processing.
And after the 2008 crisis.
Dodd-Frank, huge piece of legislation, reformed financial services, created the CFPB, added oversight for systemically important payment stuff.
But the really cutting-edge stuff is happening now with digital assets. Tell us about the Genius Act. That sounds ambitious.
It is. GENIUS stands for Guiding and Establishing National Innovation for U.S. Stablecoins Act. And it's the first federal framework just for payment stablecoins in the U.S.
Okay, remind us quickly, payment stablecoins.
Digital assets designed to hold a stable value, usually pegged one-to-one to a regular currency like the dollar, and you can redeem them for that dollar.
Got it. So what does Genius demand?
It's strict. Only permitted issuers can offer them. Think subsidiaries of insured banks or non-banks that get specific federal or state licenses.
Okay.
They must hold 1.1 reserves in really safe liquid assets, cash, bank deposits, short-term government securities,
Proof of funds, basically.
and a public proof. They have to disclose redemption policies, publish monthly reports on what's in their reserves, plus they're treated as financial institutions under the Bank Secrecy Act.
Meaning full AML and KYC.
Full AML KYC requirements. Know your customer. And it even puts limits on stablecoins issued outside the U.S. unless they meet similar standards.
So the goals are consumer protection, dollar stability, national security.
All wrapped up. It's a major step to bring stablecoins into the regulated fold.
And then there's the Clarity Act.
Yeah.
How does that fit in?
Clarity, the Digital Asset Market Clarity Act, tries to, well, clarify who regulates what for other digital assets beyond stablecoins. It mainly divides things up between the SEC and the CFTC. It introduces special rules for what it calls digital commodities, things maybe like Bitcoin or Ether, whose value comes from the tech itself, not like a share in a company.
Right, different from traditional securities.
Yeah. And it offers some exemptions from standard securities rules for initial sales if the blockchain is mature enough and ownership isn't too concentrated. Crucially, it mandates new kinds of disclosures focused on the technology, like access to the source code, transaction history visibility.
Interesting. So tech transparency.
Exactly. And it gives the SEC fraud-fighting powers over some digital commodities and stablecoins, too.
So connecting the dots, the U.S. is really wrestling with fitting these new digital things into its existing kind of piecemeal regulatory structure.
It's a definite balancing act. Innovation versus control.
Okay, let's hop across the pond to Europe.
Yeah.
They seem to have taken a more harmonized approach.
Generally, yes. More top-down coordination. Key players are the European Central Bank, ECB, overseeing the big Eurozone payment systems, and the European Banking Authority, EBA, which pushes for consistent rules across member states and has been big on open banking.
And the UK, still influential post-Brexit.
Definitely. You have the FCA Financial Conduct Authority and the PRA Prudential Regulation Authority. Interestingly, they actually folded the separate payment systems regulator into the FCA back in March 2025.
Streamlining things.
It seems to be the goal, yeah.
And Europe's big legislative drivers have been the Payment Services Directives, PSD1, PSD2, now PSD3 on the horizon.
Absolutely pivotal. PSD2, which came into force around 2018, was a real game changer. Two big things. It mandated strong customer authentication, SCA, that two-factor authentication you often need for online payments now.
Right.
And crucially, it forced banks to open up access to customer account data with consent, of course, via secure APIs. That's what really kicked off open banking in Europe.
So what's the next step with PSD3? What's that going to change?
PSD3 is expected around 2026, maybe 2027. It expands the scope quite a bit. It's looking to bring instant payments more formally into the rules, things like buy now, pay later, BNPL, crypto assets, even digital identity management.
Wow. Okay. Broader reach.
Yeah. The aims are better harmonization, stronger fraud prevention, maybe through more data sharing between providers and even stricter SCA rules. It also wants to boost open banking further by mandating standardized APIs for banks, making it easier for third parties to connect.
Making open banking smoother. And what about DORA? The Digital Operational Resilience Act. Sounds important.
It is. DORA came into effect January 2025. It's all about making sure the financial sector can withstand and recover from major operational disruptions, especially cyber incidents or IT failures.
So resilience.
Exactly. It covers governance, managing risks from third-party tech providers, reporting incidents, resilience testing, sharing threat information. It forces a much more strategic view of digital resilience.
Okay, comprehensive. Let's pivot now to Asia Pacific. Huge diversity there. But are we seeing any common trends in how they're approaching payments regulation?
You are, despite the diversity. Singapore, for instance, has been a real leader with its Payment Services Act back in 2019.
What did that do?
It pulled together older laws into one risk-based framework. And importantly, it explicitly brought digital payment token services crypto under regulation with different license types based on scale.
Okay. How about Hong Kong?
In Hong Kong, it's a bit split. Money service operators are under customs, but stored value facilities, think digital wallets and payment systems, are regulated by the HKMA, the Monetary Authority. They've also put out a draft stablecoin bill requiring an HKMA license for fiat-backed stablecoins.
Following that global trend on stablecoins.
Definitely. Then you look at India. Massive adoption of digital payments there, especially with UPI, the Unified Payments Interface. The Reserve Bank of India, RBI, keeps very close tabs on that.
Strict oversight.
Yes. And in China, there's a big push for digital integration, especially for smaller businesses, leveraging AI, 5G, which obviously impacts payment flows. They've also updated rules for multinationals managing cash across borders.
So across the board, different strategies, but everyone's grappling with new tech, stability, consumer protection.
That's the common thread. Yeah, everyone's trying to figure it out.
So beyond these regional differences, there seem to be some core pillars, universal principles of payments regulation that apply pretty much everywhere.
Yep.
Let's break those down. First up has to be licensing and authorization,
Absolutely fundamental. You can't just decide to start moving money for people. You need permission.
a legal prerequisite.
Right. And getting that license involves meeting specific criteria, like capital requirements, holding a certain amount of capital to show you're financially sound.
How much are we talking?
Varies wildly.
Mm.
In the EU, a payment institution might need €125,000, an e-money institution 350,000. In the US, state money transmitter licenses could range from $100K to over $1 million.
Big range. What else?
Safeguarding consumer funds. Making sure customer money is kept separate and safe, maybe through segregated accounts or insurance. Robust AML and KYC compliance, proving you can fight financial crime. Demonstrating operational resilience. And ongoing regulatory reporting.
So it's not just getting the license, it's maintaining it.
Continuously. And the complexity, the paperwork, different rules in different places, it's a major hurdle.
Okay, Pillar 2 is closely related. Anti-money laundering, AML, and counter-terrorist financing, CTF.
Yeah.
We mentioned FATF setting standards, but what are the actual mechanics businesses need to implement?
Right. It's about protecting the whole system from bad actors. Key components. Know your customer, KYC, and customer due diligence, CDD.
Verifying identity.
Yes, verifying who your customers are, understanding their business or source of funds, and doing enhanced checks for higher risk customers like politicians, PAPs.
Politically exposed persons, right?
Exactly. Then there's transaction monitoring, using systems to look for suspicious patterns over time, not just single transactions.
Spotting unusual activity.
And transaction screening. This is more upfront, checking names against sanctions lists before you process a payment.
Real-time checks.
Ideally, yes. And finally, if you do spot something suspicious, you have a legal duty to report it via a suspicious activity report to the authorities like FinCEN in the U.S.
It's a complex balancing act, isn't it? Tough controls versus making sure people aren't unfairly excluded from the financial system.
That's the constant tension. Financial inclusion versus crime prevention.
Pillar 3, data privacy and security. This feels more critical than ever.
Absolutely paramount. It's about preventing fraud, yes, but also just maintaining basic trust. People won't use services if they don't trust them with their data.
And there are big regulations here. GDPR in Europe.
Yeah, the General Data Protection Regulation. Huge impact globally because it applies to data of anyone in the EU, no matter where the company is based. Covers tons of personal data, gives individuals strong rights access, deletion.
And those big fines for breaches, 72-hour notification.
Exactly. Then in the U.S., you have the California Consumer Privacy Act, CCPA, giving strong rights to Californians. Other states are following suit.
And what about PCI DSS? Payment Card Industry Data Security Standard? That's not a lot, right?
Correct. It's an industry standard created by the major card brands, Visa, MasterCard, Amex, etc.
But still essential.
Absolutely essential if you handle card data. It sets detailed requirements for secure networks, access control, encrypting data, vulnerability testing, security policies. Fail to comply, and you face hefty fines from the card brands, or could even lose your ability to process cards.
So companies often need both like GDPR for general privacy and PCI DSS specifically for card data.
Exactly, a layered approach. And effective tools here are things like encryption, tokenization replacing sensitive data with token strong customer authentication.
SCAN.
Yeah, multi-factor authentication, and increasingly AI tools to spot fraud patterns.
Okay, Pillar 4. Consumer protection and dispute resolution. We touched on this, but let's revisit the mechanisms.
This is about ensuring fairness for the end user. Key tools include transparent disclosures. Laws like IFTA and TILA require clear information upfront about terms, fees, etc.
No hidden surprises.
That's the goal. Then, dispute resolution procedures. Like the Fair Credit Billing Act in the U.S. gives you the right to challenge errors on your credit card bill, requires the issuer to investigate, and lets you withhold payment during that time.
Powerful tool for consumers.
Very. And limits on consumer liability. That famous $50 limit for unauthorized credit card use is a prime example. Protects you from catastrophic loss if your card is stolen.
And chargebacks.
Crucial. The mechanism allowing cardholders to basically reverse a payment if goods weren't delivered, or it was fraudulent, or there's a billing error. It puts the onus back on the merchant and their bank to resolve it.
So businesses need good communication to avoid these.
Definitely. Clear pricing, easy-to-find refund policies, good customer service. It can prevent a lot of disputes from escalating to formal chargebacks.
Makes sense. Final pillar, operational resilience and risk management. You said this is getting more focused now.
Huge focus. It's broader than just having a backup plan for disasters. Operational resilience is about an institution's ability to keep operating through severe disruptions, cyber attacks, IT failures, pandemics, whatever, and recover quickly.
So staying functional under stress.
Exactly. It's critical because failures in people, processes, or systems, operational risks can cause massive financial losses, reputational damage, especially with complex tech and reliance on third-party vendors.
So what does managing this involve?
It means systematically identifying, assessing, and mitigating risks. That might involve selling risky assets, buying insurance, using hedging strategies, diversifying systems.
That's a friendly risk.
Yeah. Plus continuous risk reporting and monitoring internally, and strong risk governance, clear accountability from the top.
And regulators are demanding this.
Increasingly so. U.S. regulators are asking for industry input specifically on payments fraud resilience. The Bank of England set deadlines for firms to meet impact tolerances by March 2025. And the EU's DORA regulation we mentioned, that's all about mandating resilience measures for ICT risks.
So being proactive is key. Updating security, having recovery plans.
Non-negotiable in today's environment.
Okay, that covers the foundations. Now, the exciting part looking ahead, the payments world never stands still. What are the big trends shaping the future regulatory landscape? Let's start with the obvious one. Digital assets, crypto, stablecoins, CBDCs.
Yeah, this is the frontier everyone's watching. As adoption grows, regulatory scrutiny intensifies. We talked about stablecoins and their potential for payments.
And the Genius Act in the U.S. setting that federal framework.
Right. Strict reserves, disclosure, AML, KYC, trying to make them safe and integrate them into the system.
And for other assets, like Bitcoin.
The Clarity Act in the U.S. trying to sort out SEC versus CFTC jurisdiction, focusing on those tech disclosures. It's still evolving everywhere, though.
Then there are central bank digital currencies, CBDCs. Lots of countries exploring these.
Over 135. Last count. Many see potential for financial inclusion, more efficient payments, better monetary policy tools.
But the U.S. is hesitant.
Right.
Particularly about a retail CBDC anyone could use.
Very hesitant. That CBDC Anti-Surveillance State Act we mentioned aims to block a retail CBDC unless Congress explicitly approves it. The big concerns are privacy, government surveillance, control. It makes the U.S. a real outlier compared to many other major economies exploring CBDCs.
So this whole digital asset space raises that core question again. How do you balance innovation with safety and control?
That's the question regulators globally are grappling with. The trend is definitely towards creating clear rules, but the rules themselves are still being written and debated.
Another huge trend, open banking and open finance. This feels like a fundamental rewiring.
It really is. Open banking, at its core, is about enabling secure, real-time data sharing between banks and approved third parties' fintechs, usually, but only with the customer's explicit consent.
So you control your data sharing.
You're supposed to. And this allows for amazing new services apps that aggregate all your accounts, faster loan decisions because lenders can see your real-time finances, easier ways to fund investment accounts instantly.
Driven by regulations like PSD2 in Europe.
PSD2 was the catalyst there. PSD3 aims to standardize the APIs to make it work even better. In the U.S., the CFPB is working on rules to give consumers more control over their financial data, which will likely boost open banking principles. Other regions are developing their own versions.
And open finance takes it even further.
That's the next step, extending the data sharing principles beyond just bank accounts to include investments, insurance, pensions, mortgages, creating a much more holistic financial picture, driven by AI, maybe blockchain, DeFi concepts.
But the challenges must be huge. Security, privacy.
Absolutely. It requires incredibly robust security encryption, tokenization, proactive risk management, SCA, AI fraud detection becomes even more vital. And building and maintaining user trust is paramount. Clear communication about how data is used, strong privacy policies, that's key for adoption.
Okay, final trend. Given how global payments are, global harmonization efforts must be underway. trying to get everyone on the same page.
They have to be. The cross-border nature demands consistency. Otherwise, you get regulatory arbitrage companies setting up where rules are weakest and friction in international payments.
So who's leading this charge?
Key international bodies. The Bank for International Settlements, BIS, in Basel, the Central Bankers Bank, is a major forum for discussion and research.
Okay.
Within the BIS, the Committee on Payments and Market Infrastructures, CPMI, sets international standards. They're working closely with the Financial Stability Board, FSB, on a big project to improve cross-border payments, making them faster, cheaper, more transparent, more accessible. They have this roadmap with 19 building blocks.
Ambitious.
Very. And of course, FATF, the Financial Action Task Force, continues its critical work setting global standards for AML-CTF. Their recommendations influence laws everywhere.
Is there technical harmonization happening too, like common standards?
Yes, that's a big part of it. Pushing for standardized APIs, like we mentioned for open banking, and common messaging formats for financial transactions, like ISO 2022. Using the same language reduces cost and complexity for everyone involved in cross-border flows.
So ultimately, the future depends on this global cooperation.
It really does. No single country can regulate the global payment system effectively on its own. It requires constant dialogue and collaboration.
Wow. What a journey through a complex world. So to wrap up this deep dive, the payments industry is clearly in massive flux.
Unprecedented transformation, really.
And regulation is this dynamic thing, trying to keep up, protecting consumers, keeping the system stable, ensuring fair markets, fighting crime, and somehow still letting innovation happen responsibly.
And I think the big takeaway is how that regulatory line keeps moving outwards. Non-banks, digital assets, they're increasingly in scope.
Meaning businesses have to think about compliance from day one. That compliance by design idea.
Exactly. It's not an afterthought anymore. It has to be baked in.
And looking forward, it's all about that continued conversation, regulators talking to each other internationally, talking to the industry. It's a shared load, this compliance and risk management.
Definitely a shared responsibility.
So here's a final thought for you listening. As this tech keeps accelerating, how might your role as a consumer, maybe as someone working in this field, how might your role shift in shaping what this regulatory future actually looks like?
Yeah, that's interesting.
Will we see consumers having more direct say, or will it stay mostly with governments and these big global bodies? Something to think about next time you tap your phone to pay.